a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Let's get the spoken word on the stock market now from our chief equity strategist, John Blank, who joins me via Skype from the West Coast. John, stock market came into this new year, 2016, on a decidedly bearish note. And here we are just a little bit past the middle of January, and that tone doesn't seem to have let up much at all. So for those people putting stock in that January effect, is this what they're going to be looking at through the rest of the year?
Well, Terry, the issue here that the market's trying to straighten out is we've had a very modest negative earnings growth rate on the S&P 500 because of the oil price collapse. And this modest negative earnings growth rate was also seen in 1999 and 2000, and it was seen again in 2007 to 2008. So in those two periods, it was the tech bubble and, the euphoria of that period that was going to go on forever and led to a crash. And in housing, the idea was that we were going to have a housing price correction, and we had a huge housing price collapse. So take that into play number 3 here. Now we have an oil price crash, a bubble that has clearly emerged within the oil and materials case that was built up over 10 years, led to that $130 barrel oil price in 2007, which caused this massive oversupply, which then was helped along by China, and now we're seeing the back end of this. And the next question is this going to be another recession?
So as market activity goes, John, at least here for the U.S. market, is this really all about just oil and China, or is there something else going on?
No, Terry, it's oil and materials in the industrial space that are connected to supplying the pipe and the transportation and all the equipment for the drillers. So what it is, it's the old economy that got some breath, some life through the high oil prices and high materials prices the last 10 years. And this stuff is going down. So that is the question. Why can we expect this to emerge? Because we have another 7 or 8 sectors of the U.S. economy where there are strong companies and strong stocks, and where lower oil prices are going to give an income effect. So the question is that going to be strong enough to wipe out the losses that we're seeing in those 3 sectors?
So do you call this a market correction, or is this the beginning of the big bear?
Well, the bear market is already here in Europe. It's in here in Russia. It's in here in Canada. It's in here in Australia. It's here in Japan. So the bear market is here outside the United States for sure. And we have a correction in place in the United States now. So what we're at is whether the United States correction is just a correction and we go back up, because there is no recession in the United States, because we have so many strong sectors that don't need oil materials and benefit from the falling prices, or whether the world, which is a little further behind in our technology and in knowledge and services, whether the world just sucks us in and we go down with them.
So any market rebounds here, are you looking for those to be short-lived?
Terry, the jury is out, and that's the problem. I wish I could tell you with some certainty that I think this is a correction and not a bear market, but it's clearly a deep correction already. And the only missing piece here is the fundamentals haven't collapsed in the United States. And I don't think they're going to. I personally think this is a correction, but there's no question, Terry, outside of the United States that there are recessions in places like Canada, there are recessions in places like Japan and Russia and Brazil, and that those bear markets are correct in forecasting. So the problem is the market just doesn't know the dimensions of this particular situation.
All right, so against that backdrop, John, you say, though, there are still some stock bargains out there to be found, and you found a couple for us.
Yeah, I like Cerner Corporation. They're a Kansas City-based healthcare infotech provider. So now you have the Obamacare roll-up with millions of exchanges being put in place, all those databases. You've got the need for these high-level upgrades to infotech systems. They're an old Arthur Anderson company partnership there, and they ticker CRERN. Stock sold off real nice down in the 50s. You've got an A for growth in Zacks, and you've got 1 or 2 ranks for Zacks ratings short term for the last few months. So they're clearly a play that you want to look into, because they're in healthcare and they're in that stable earnings growth space that can take this whole market up. The other one I like is Mellanox. This is 10% owned by Oracle. And this is a company that started a few decades ago, but they're based partly in Israel, partly in the United States. and their back end, they're fabless. So the people who are really making the chips are in Taiwan, at Taiwan Semiconductor, which is a big company there. So between Oracle and Taiwan Semiconductor, we've got this sort of Israeli hybrid tech chip company, and then they're very attractively growing. And now we got this pullback. It might be time to buy them in another few weeks.
All right, there you have it, the spoken word on the stock market, and a couple of bargain stocks thrown in for good measure. From our chief equity strategist, John Blank. With John, I'm Terry Ruffalo.